The world's largest corporations are reporting record profits, celebrating soaring valuations, and rewarding executives as if the future were guaranteed. Stock markets signal prosperity. Headlines speak of strength, and investors are told that everything is under control. But beneath this polished surface lies a dangerous contradiction. Many of these companies are not funding themselves. They are refinancing themselves. They are not growing stronger. They are surviving longer. This is not a story about a sudden crash. It is a story about how an economy can look rich while quietly running out of cash. The modern corporate world presents a picture of unprecedented prosperity. Stock indices sit near historic highs, quarterly earnings headlines announce record-breaking profits, and market capitalizations of the largest corporations exceed the gross domestic product of entire nations. To the casual observer, and even to many seasoned investors, this visual narrative seems undeniable. The global economy appears strong, corporations appear efficient, and capital appears abundant. Yet this image is not a reflection of economic health. It is a carefully constructed illusion built on financial engineering, monetary distortion, and a profound misunderstanding of what corporate success truly means. Over the past decades, the definition of wealth has quietly shifted. In classical economic terms, a successful company generated consistent cash flows, reinvested profits into productive capacity, and strengthened its balance sheet over time. Today, success is measured primarily through share price appreciation and accounting-based earnings. These two metrics dominate media coverage, investor sentiment, and executive incentives. However, neither guarantees financial resilience. A rising share price does not require rising productivity, nor does reported profit require an increase in real economic value. One of the most powerful drivers behind this illusion is the structure of modern financial markets. Equity valuations are no longer anchored to long-term fundamentals, but to liquidity conditions. When central banks inject capital into the system, that money must go somewhere. It flows first into financial assets, inflating stock prices regardless of whether the underlying businesses improve. As a result, companies appear richer simply because their shares trade higher, not because they generate more real value for the economy. This phenomenon creates a dangerous feedback loop. Rising share prices allow companies to present themselves as successful, which attracts more investors, which pushes prices even higher. Executives are rewarded with stock-based compensation, encouraging them to prioritize short-term market perception over long-term stability. The balance sheet becomes secondary to the stock chart. Wealth becomes a narrative rather than a reality. Another layer of the illusion lies in how profits are reported. Corporate earnings are not a direct measure of cash. They are the result of accounting frameworks that allow extensive interpretation. Non-cash adjustments, deferred expenses, asset revaluations, and aggressive revenue recognition all contribute to earnings that look impressive while hiding underlying weakness. A company can report strong profits while simultaneously borrowing to fund operations, dividends, and share buybacks. To the public, this appears as strength. In reality, it is dependency. The media plays a crucial role in sustaining this perception. Financial news focuses on earnings beats, market rallies, and record valuations. Rarely does it emphasize cash flow deterioration, rising leverage, or declining return on invested capital. Headlines celebrate growth without questioning its quality. The narrative becomes self-reinforcing, and skepticism is framed as pessimism rather than analysis. Global economic statistics further complicate the picture. Aggregate corporate profits as a share of output have risen in many advanced economies, yet productivity growth has stagnated. This contradiction is explained by financialization. Companies increasingly generate profits not through innovation or efficiency, but through cost-cutting, labor suppression, tax optimization, and financial maneuvers. These strategies inflate margins temporarily, but weaken the economic foundation over time. Consider the role of share buybacks. Corporations spend enormous sums repurchasing their own shares, reducing the number of shares outstanding, and mechanically increasing earnings per share. This boosts valuation metrics without improving the underlying business. Buybacks are often financed through debt, transforming balance sheet strength into market optics. The company appears more profitable while becoming more fragile. This illusion is global in scope. In developed markets, corporations benefit from ultra-accommodative monetary policy and deep capital markets. In emerging economies, firms rely on external financing and currency exposure to sustain growth narratives. In both cases, appearances are prioritized over resilience. The result is a corporate sector that looks wealthy on the surface, but is increasingly vulnerable to shocks. The psychological impact on investors cannot be overstated. Rising markets create a belief that risk has disappeared. Valuation concerns are dismissed as outdated. Debt is seen as harmless, even optimal. The idea that large corporations could fail seems implausible. This mindset is not born from evidence, but from prolonged exposure to distorted signals. At the macro level, this illusion reshapes policy decisions. Governments interpret strong markets as confirmation of economic success. Structural reforms are delayed. Productivity challenges are ignored. Inequality widens as asset owners benefit disproportionately from financial inflation, while wage growth remains subdued. The economy appears strong, but social and financial tensions build beneath the surface. The illusion of wealth is not merely a misunderstanding. It is a systemic feature of the modern economic model. It allows inefficiency to persist, misallocates capital, and rewards behavior that undermines long-term stability. Corporations that should restructure survive. Businesses that should fail continue operating. Capital flows toward financial engineering rather than productive investment. What makes this illusion particularly dangerous is its longevity. The longer it persists, the more normal it appears. A generation of investors has grown accustomed to markets that rise regardless of fundamentals. Executives have learned that perception outweighs performance. Policymakers have come to rely on asset prices as indicators of success. The gap between appearance and reality widens quietly, steadily, and invisibly. This chapter is not about predicting collapse. It is about understanding distortion. When wealth is defined by valuation rather than value, when profit is detached from cash, and when growth is measured in prices rather than productivity, the system becomes fragile by design. The illusion holds as long as confidence remains intact. But confidence is not capital, and perception is not solvency. The modern corporate economy stands on a foundation that looks solid only because it is constantly reinforced by narrative, liquidity, and belief. Strip those away, and what remains is far less impressive than the numbers suggest. Profit has become one of the most misunderstood words in modern capitalism. It is quoted endlessly, celebrated obsessively, and trusted almost blindly. Yet very few people truly understand what it represents in the contemporary corporate system. In theory, profit is simple. Revenue exceeds costs, leaving surplus value that belongs to the owners of the business. In practice, profit today is an accounting construct shaped by assumptions, timing decisions, and financial incentives that often have little connection to real economic strength. This disconnect is not accidental, it is structural. To understand why profitable companies often struggle for cash, one must first separate accounting profit from economic reality. Corporate income statements are governed by accrual accounting, not cash accounting. This means revenues are recognized when they are earned, not when money is received, and expenses are recorded when incurred, not when paid. This framework was designed to smooth business cycles and reflect long-term performance. Over time, however, it has become a tool that allows companies to report strength while hiding strain. A corporation can record revenue long before a customer pays. It can capitalize costs instead of expensing them immediately. It can depreciate assets over extended periods, reducing current expenses. It can recognize gains from asset revaluations that generate no cash whatsoever. All of this inflates reported profit without improving liquidity. The income statement looks healthy, while the cash flow statement quietly deteriorates. This divergence has grown dramatically in recent decades. As business models have become more complex and global, the gap between earnings and cash has widened. Subscription services recognize revenue over time, even when upfront costs are significant. Technology companies capitalize development expenses. Manufacturing firms stretch payment terms with suppliers while extending generous credit to customers. Each individual practice appears rational. Combined, they create a system where profit is abundant and cash is scarce. The rise of non-cash adjustments has further blurred the picture. Terms like adjusted earnings, normalized profit, and earnings before interest, taxes, depreciation, and amortization dominate corporate reporting. These metrics exclude real costs under the justification that they are non-recurring or non-operational. In reality, many of these costs recur regularly. Stock-based compensation, restructuring charges, impairment losses, and legal expenses are treated as exceptions even when they are persistent features of the business. Profit becomes a curated narrative rather than an objective measure. Cash flow tells a different story. Operating cash flow reveals whether a company can sustain itself without external financing. Free cash flow shows whether it can invest, reduce debt, or return capital to shareholders without borrowing. In many sectors, these figures paint a far less optimistic picture than headline earnings. Companies that appear highly profitable often rely on continuous inflows of new capital to function normally. This dependency is masked by the availability of cheap credit. When borrowing costs are low, negative cash flow does not feel like a problem. Debt fills the gap between reported profit and actual liquidity. Interest expenses are manageable, maturities can be extended, and refinancing is readily available. As long as this environment persists, profit without cash seems sustainable. The risk is postponed, not eliminated. Recent global developments highlight the fragility of this arrangement. As monetary conditions tightened in major economies, companies with weak cash generation faced immediate pressure. Rising interest expenses exposed balance sheets that had been optimized for low-rate environments. Businesses that had relied on rolling over debt discovered that profit figures offered no protection against liquidity stress. Earnings did not pay bills. Cash did. Another critical factor is the treatment of working capital. Growth often consumes cash before it generates it. Expanding sales requires inventory, longer receivable cycles, and upfront investment. Companies chasing revenue growth can report higher profits while draining cash reserves. This is particularly evident in sectors where competition forces generous payment terms or heavy promotional spending. Growth is celebrated, even as liquidity erodes. The problem is compounded by investor expectations. Markets reward earnings growth far more than cash discipline. Executives respond accordingly. Decisions are made to maximize reported profit per share, even if they weaken cash flow. Delaying expenses, accelerating revenue recognition, and leveraging the balance sheet all improve short-term metrics. Long-term resilience is sacrificed for immediate valuation gains. This behavior is reinforced by compensation structures. Management bonuses and stock awards are typically tied to earnings targets and share price performance. Rarely are they linked directly to free cash flow stability or balance sheet strength. Rational actors respond to incentives. If profit optics are rewarded and liquidity discipline is ignored, the outcome is predictable. The broader economic implications are significant. Capital is allocated based on misleading signals. Companies that generate real cash are undervalued relative to those that generate accounting profit. Investment flows toward businesses that look successful rather than those that are sustainable. Over time, this distorts competition and weakens productivity growth across the economy. At the macro level, this profit illusion feeds into policy complacency. Strong corporate earnings are interpreted as evidence of economic health. Structural issues such as declining investment, rising leverage, and fragile supply chains receive less attention. The system appears stable precisely because its weaknesses are hidden behind favorable accounting results. Profit without cash is not inherently fraudulent. It is often legal, accepted, and even encouraged. The danger lies in its normalization. When entire sectors operate with minimal liquidity buffers, the margin for error disappears. Small shocks become systemic threats. Confidence becomes the primary stabilizing force, and confidence is inherently volatile. This is the foundation upon which the modern corporate illusion rests. Profit has become detached from money, success detached from solvency, and growth detached from sustainability. The numbers look impressive, but they do not tell the whole story. The real story is written in cash flows, refinancing schedules, and balance sheet footnotes that few bother to read. And this is only the beginning. The deeper one looks into corporate cash dynamics, the clearer it becomes that profit without liquidity is not an anomaly, but a defining feature of the modern economic system. What once would have been considered a warning sign is now normalized, even celebrated. Companies proudly announce earnings growth while quietly issuing debt, selling assets, or stretching obligations to survive. This inversion of financial logic did not happen overnight. It evolved gradually, shaped by monetary policy, market structure, and investor psychology. One of the most critical yet overlooked mechanisms behind this phenomenon is the treatment of capital expenditures. Many companies defer or minimize productive investment to preserve short-term profit metrics. Maintenance spending is delayed, infrastructure ages, and innovation budgets are trimmed. On paper, margins improve. In reality, future earning capacity deteriorates. Cash that should be reinvested into productive assets is instead redirected toward financial maneuvers that support valuation. The cost of this decision is invisible in the short term and devastating in the long term. At the same time, balance sheets have become instruments of performance management rather than resilience. Debt is no longer viewed as a temporary bridge, but as a permanent feature of corporate finance. Companies refinance existing obligations repeatedly, extending maturities without reducing principal. This creates the illusion of stability. As long as refinancing remains possible, insolvency appears distant. However, this stability is conditional. It depends entirely on market access and favorable credit conditions. The role of financial intermediaries amplifies this dynamic. Investment banks, asset managers, and rating agencies all operate within frameworks that reward continuity. As long as a company can service interest and maintain appearances, it is classified as viable. Downgrades and scrutiny often arrive only after liquidity has already deteriorated significantly. By then, options are limited. Profit figures that once reassured investors offer no defense against a sudden loss of confidence. Another layer of distortion arises from global supply chains. Corporations have optimized operations for efficiency, not robustness. Inventory levels are minimized, suppliers are pressured, and production is synchronized tightly with demand forecasts. This reduces costs and boosts reported profitability. It also eliminates buffers. When disruptions occur, companies are forced to absorb shocks without financial flexibility. Cash outflows spike while inflows lag. Profit projections quickly become irrelevant. The widespread adoption of just-in-time models illustrates this vulnerability. What improves margins under stable conditions becomes a liability during volatility. The absence of slack turns minor disruptions into liquidity crises. Yet these risks are rarely reflected in profit forecasts or valuation models. They exist outside the narrative of earnings growth and market optimism. Financial markets further obscure reality through valuation techniques that discount the importance of cash. Low discount rates inflate the present value of distant earnings, encouraging investors to overlook near-term liquidity weakness. As long as future profits are assumed to materialize, current cash shortfalls are tolerated. This logic holds only as long as assumptions remain unquestioned. When conditions change, valuations adjust violently. Recent market episodes have demonstrated how quickly this tolerance can evaporate. Companies once praised for growth and profitability faced abrupt sell-offs when cash concerns surfaced. In many cases, there was no sudden deterioration in earnings. What changed was perception. Investors began asking different questions. How much cash does this company actually generate? How dependent is it on external financing? How resilient is it under stress? These questions arrive late, but when they do, they dominate. The corporate response to these pressures often deepens the problem. To protect earnings metrics, companies cut costs aggressively, including labor and investment. This preserves short-term profit while weakening long-term competitiveness. Cash is conserved temporarily, but growth potential declines. The cycle repeats. Profit survives, value erodes. This pattern has systemic consequences. An economy dominated by firms that prioritize accounting performance over cash sustainability becomes fragile. Innovation slows. Productivity stagnates. Risk accumulates silently. The illusion of profitability masks a gradual erosion of economic capacity. It is important to understand that this is not merely a corporate issue. It reflects a broader cultural shift in how success is defined. Numbers that are easy to communicate and celebrate dominate discourse. Earnings headlines travel faster than cash flow statements. Valuations attract more attention than balance sheets. Complexity is simplified into narratives that favor optimism. As a result, the market becomes less a mechanism for allocating capital efficiently and more a machine for amplifying belief. When belief is strong, profit without cash is acceptable. When belief weakens, the absence of cash becomes fatal. There is little middle ground. This chapter exposes a central contradiction of modern capitalism. The system rewards appearances over substance, momentum over durability, and narrative over reality. Profit, once a signal of strength, has been stripped of its meaning. Cash, once a given, has become a luxury. Understanding this contradiction is essential. It explains why companies can appear prosperous while standing on fragile ground. It clarifies why market booms can coexist with economic stagnation. And it sets the stage for what comes next, when the mechanisms that sustain the illusion are tested. Because when profit is no longer enough, only cash remains. Debt has quietly transformed from supporting tool of corporate finance into its central pillar. What was once used sparingly to smooth investment cycles or fund expansion has become the primary mechanism through which modern companies survive, grow, and maintain the illusion of strength. This shift did not occur because debt suddenly became safer. It occurred because the global financial environment made it feel painless. For years, borrowing was cheap, abundant, and endlessly renewable. In that environment, debt stopped being perceived as a liability and started being treated as a resource. The modern corporate economy is built on the assumption that refinancing will always be possible. Maturities are extended, interest payments are rolled forward, and principal is rarely reduced in meaningful terms. Balance sheets are engineered not for repayment, but for continuation. The objective is not to eliminate debt, but to manage its appearance. As long as obligations can be pushed into the future, the present remains comfortable. This logic has reshaped corporate behavior at every level. Executives no longer ask whether a project can be funded internally. They ask whether it can be financed cheaply. If the cost of debt is lower than the perceived cost of equity, borrowing becomes the default choice. Even companies with substantial profits choose leverage over retention. Debt amplifies returns during favorable conditions and masks weaknesses during stable ones. The risks are deferred, often beyond the tenure of current management. Central banks played a decisive role in enabling this transformation. Prolonged periods of ultra-low interest rates altered incentives across the economy. Capital became abundant, and the penalty for borrowing disappeared. Companies that once would have faced market discipline for excessive leverage were rewarded instead. Investors searching for yield accepted lower compensation for higher risk. Credit spreads narrowed. The signal that debt should send was muted. As a result, corporate debt levels rose steadily across the globe. In advanced economies, non-financial corporate borrowing expanded far faster than economic output. In emerging markets, firms borrowed heavily in foreign currencies, betting on stable exchange rates and continuous access to global capital. In both cases, the underlying assumption was the same. Conditions that made borrowing easy would persist indefinitely. Debt was not only used to fund investment. Increasingly, it financed financial engineering. Share buybacks became a preferred use of borrowed funds. Dividends were maintained even when free cash flow was insufficient. Acquisitions were pursued aggressively, justified by synergies that often failed to materialize. Each of these actions supported short-term valuation while increasing long-term vulnerability. The normalization of refinancing changed the meaning of solvency. A company no longer needed to generate enough cash to pay down debt. It only needed to service interest and maintain market confidence. This distinction is critical. Solvency became conditional rather than absolute. Survival depended not on internal strength, but on external willingness to provide capital. This dependency is subtle but profound. It shifts power from the productive economy to the financial system. Corporations become sensitive to changes in credit conditions, investor sentiment, and monetary policy. Their fortunes are tied less to customers and operations, and more to interest rates and market access. The real economy becomes a secondary concern. Recent years have exposed the fragility of this structure. As inflationary pressures emerged and monetary authorities signaled tighter policy, the cost of debt began to rise. Refinancing windows narrowed. Risk premiums increased. Companies that had built their strategies around perpetual cheap money found themselves exposed. Debt that was manageable under one set of assumptions became burdensome under another. The impact was uneven but revealing. Firms with strong cash generation adjusted. Those reliant on refinancing struggled. Interest coverage ratios deteriorated. Credit ratings came under pressure. Balance sheets that once looked optimized revealed hidden stress. In many cases, earnings remained positive. The problem was not profitability, it was dependency. This distinction matters. A profitable company can fail if it cannot refinance. A loss-making company can survive if it can. This inversion of logic is a hallmark of a debt-driven system. It rewards access over efficiency, scale over resilience, and connections over fundamentals. The global nature of corporate debt amplifies systemic risk. Financial markets are interconnected. Stress in one region transmits quickly to others. Currency mismatches, cross-border lending, and synchronized refinancing cycles create vulnerability. When conditions tighten, they tighten everywhere. The assumption that debt can always be rolled over becomes dangerous when many companies attempt to do so simultaneously. Another consequence of the debt economy is the distortion of competition. Firms that rely heavily on borrowing can undercut competitors that operate more conservatively. Lower financing costs allow aggressive pricing, expansion, and acquisition. This pressures healthier companies to adopt similar strategies or risk losing market share. Prudence becomes a disadvantage. Over time, this dynamic reshapes entire industries. Leverage becomes normalized. Balance sheets become stretched. Margins are protected through scale rather than efficiency. The industry appears strong, but it is brittle. A small disruption can have outsized effects. The debt economy also alters labor dynamics. When servicing obligations becomes a priority, flexibility is reduced. Costs must be controlled. Investment in human capital is deprioritized. Wages stagnate. Employment becomes more precarious. These outcomes are not reflected in corporate profit figures, but they shape economic reality. This first part of the chapter establishes a critical truth. Debt is no longer a supplement to corporate finance. It is its foundation. The modern corporation is not built to repay what it owes. It is built to roll it forward. Stability is not earned through strength. It is borrowed through confidence. And confidence, once shaken, is difficult to restore. The consequences of a debt-centered corporate system extend far beyond individual balance sheets. When refinancing replaces repayment as the primary survival strategy, the entire economic architecture shifts. Risk does not disappear. It accumulates, spreads, and concentrates in places that are difficult to observe until stress reveals them. This is how debt stops being a corporate issue and becomes a systemic one. One of the most dangerous features of the modern debt economy is synchronization. When borrowing is cheap and abundant, companies across sectors and regions take advantage of similar conditions at the same time. They issue debt with comparable maturities, often clustered within a few years. As long as markets remain open, this creates the illusion of stability. But when conditions change, refinancing needs converge. What was manageable in isolation becomes unmanageable in aggregate. This creates refinancing cliffs. Large volumes of corporate debt come due within narrow time windows. Under normal conditions, these maturities are rolled forward quietly. Under stress, they become pressure points. Credit markets cannot absorb simultaneous refinancing demand without repricing risk. Interest rates rise, lending standards tighten, and access becomes selective. Companies that depended on seamless rollover suddenly face existential questions. The response to this pressure often accelerates instability. Firms rush to secure financing before conditions worsen. This increases the supply of new debt, precisely when demand weakens. Prices fall, yields rise, balance sheets deteriorate further. The act of trying to preserve stability amplifies volatility. What began as a change in monetary conditions becomes a self-reinforcing cycle. Another critical vulnerability lies in the structure of modern credit markets. A significant portion of corporate debt is held not by traditional banks, but by asset managers, pension funds, insurance companies, and retail investors through bond funds and exchange-traded products. These investors expect liquidity. They can sell quickly. The underlying assets cannot. This mismatch creates fragility. When sentiment shifts, outflows accelerate. Funds sell bonds to meet redemptions. Prices fall regardless of fundamentals. Credit spreads widen. Companies that appeared stable suddenly face market-based distress. Their cost of capital rises not because their business deteriorated, but because liquidity evaporated. Debt that was serviceable becomes oppressive overnight. This market-driven instability interacts dangerously with accounting-based confidence. Earnings reports lag reality. By the time financial statements reflect stress, markets have already reacted. Executives are forced to respond under pressure, often making decisions that prioritize survival over strategy. Assets are sold at unfavorable prices. Investment is cut. Employment is reduced. These actions protect cash temporarily, but weaken long-term viability. The debt economy also distorts innovation. Highly leveraged companies are less willing to take risks that do not generate immediate returns. Research and development becomes harder to justify when cash must be reserved for interest payments. Incremental improvements replace transformative ideas. The economy grows more cautious, less dynamic, and increasingly dependent on financial engineering rather than technological progress. At the same time, leverage reshapes corporate governance. Creditors gain influence. Covenants restrict flexibility. Strategic decisions are made with lenders in mind rather than customers or employees. Management focus shifts from building value to managing obligations. The company becomes a vehicle for servicing debt rather than creating opportunity. This dynamic feeds back into macroeconomic outcomes. High corporate leverage reduces the effectiveness of policy responses. When interest rates rise to control inflation, heavily indebted firms feel immediate pain. When rates fall to stimulate growth, borrowing increases further, deepening dependency. Policy becomes trapped between inflation risk and financial instability. Each intervention solves one problem while worsening another. The debt economy also changes how crises unfold. Traditional downturns were characterized by falling demand and declining profits. In a debt-driven system, liquidity crises can occur even when demand remains intact. Companies fail not because they are unprofitable, but because they cannot refinance. This creates sudden, non-linear outcomes. Stability persists until it breaks, then breaks rapidly. History offers repeated examples of this pattern. Periods of prolonged credit expansion create confidence, complacency, and leverage. When conditions reverse, the adjustment is abrupt. The difference today lies in scale and integration. Corporate debt is larger, markets are faster, and interconnections are deeper. The margin for error is smaller. What makes this particularly dangerous is that the system appears functional until it does not. Defaults remain low, markets remain calm. Earnings remain positive. Observers conclude that concerns are overstated. Yet beneath the surface, resilience is eroding. Companies are less able to absorb shocks. Households are more exposed through pensions and investments. Governments are constrained by their own debt burdens. The debt economy does not collapse under pressure. It fractures. Stress concentrates in weak points, spreads through channels of confidence and liquidity, and forces rapid repricing of risk. By the time the narrative shifts, the adjustment is already underway. Understanding this is essential. Debt is not merely a financial variable. It is a structural dependency that reshapes incentives, behavior, and outcomes across the economy. When repayment is replaced by refinancing, stability becomes conditional, growth becomes fragile, and confidence becomes the most valuable and most volatile asset of all. This is the hidden cost of an economy built on borrowed time. The rise of zombie corporations is not an accident of poor management or bad luck. It is the logical outcome of a financial system that prioritizes liquidity over productivity and survival over efficiency. A zombie company is not necessarily one that is visibly failing. It is a company that cannot sustainably service its debt from operating profits, yet continues to exist because external financing remains available. It walks, trades, hires, and reports earnings, but it does not truly live. Its continued existence depends entirely on the willingness of markets to extend credit. In earlier economic cycles, such firms would have been forced to restructure or exit. Market discipline played a corrective role. Capital flowed away from inefficient businesses and toward productive ones. Failure, while painful, served a purpose. It freed resources, labor, and capital for better uses. In the modern economy, this mechanism has been weakened. Instead of clearing, the system preserves. Instead of reallocating, it sustains. The expansion of zombie corporations accelerated during prolonged periods of low interest rates. When the cost of capital approaches zero, the distinction between viable and non-viable businesses blurs. Companies that generate insufficient returns can still refinance cheaply. Losses can be carried forward indefinitely. Weak cash flow is tolerated as long as interest payments are met. Survival becomes a function of credit access rather than economic contribution. This shift has measurable consequences. Across multiple advanced economies, the share of firms unable to cover interest expenses from operating income has risen steadily over time. These companies are not small outliers. Many are large, publicly traded entities embedded deeply within supply chains and financial markets. Their persistence is not a sign of resilience. It is a sign of distortion. Zombie firms absorb capital that could otherwise support productive investment. Banks, investors, and funds continue to allocate resources to businesses that generate low or negative returns because exiting would force recognition of losses. This creates a feedback loop. The longer these firms survive, the more entrenched they become. The cost of failure rises, making continuation the path of least resistance. The impact on competition is profound. Zombie companies often maintain market presence by suppressing prices, delaying necessary restructuring, and cutting costs aggressively. Healthier firms are pressured to follow suit. Margins compress, investment declines, innovation slows. An industry populated by zombies becomes stagnant, not because demand is weak, but because capital is misallocated. Labor markets are affected as well. Zombie firms tend to underinvest in workforce development. Wages stagnate. Job security erodes. Workers remain employed, but opportunities for advancement diminish. This creates an illusion of stability while undermining long-term growth potential. Employment is preserved, but productivity suffers. Financial markets contribute to this outcome through valuation practices that reward scale and continuity over efficiency. As long as a company remains listed and liquid, it can attract passive investment flows. Index inclusion provides a steady stream of capital regardless of underlying health. Investors may not consciously choose zombie firms, but they fund them indirectly through broad market exposure. The distinction between strong and weak businesses fades within aggregate portfolios. Credit markets reinforce the pattern. Lenders often prefer extending and pretending over forcing restructuring. Rolling over debt avoids immediate losses and preserves balance sheet appearances. Covenants are relaxed, maturities are extended, risk is deferred. What begins as a temporary accommodation becomes a permanent condition. Global conditions have amplified this phenomenon. In regions facing demographic decline, slow productivity growth, or structural stagnation, zombie firms act as a buffer against social disruption. They preserve employment and output in the short term. Policymakers tolerate their existence to avoid unemployment spikes and political backlash. Stability is prioritized over renewal. However, this stability is deceptive. An economy populated by zombie corporations becomes less dynamic and more fragile. Growth relies increasingly on external stimulus rather than internal innovation. Shocks have greater impact because buffers are thin. Recovery becomes slower because resources are trapped in inefficient uses. Recent global events have exposed these vulnerabilities. Periods of supply chain disruption, energy price volatility, and tightening financial conditions have disproportionately affected zombie firms. Their lack of flexibility, weak balance sheets, and dependence on refinancing leave them vulnerable to even modest stress. Yet rather than exiting, many seek additional support. The cycle continues. The presence of zombies also distorts macroeconomic indicators. Aggregate employment may appear stable. Corporate profits may look robust, yet underlying productivity growth remains weak. Investment lags. Potential output declines. Policymakers misinterpret signals, believing the economy is healthier than it truly is. What makes zombie corporations particularly dangerous is not their individual weakness, but their collective impact. Each one may seem manageable. Together, they represent a drag on growth and a source of systemic risk. They crowd out new entrants. They slow technological adoption. They reduce the economy's ability to adapt. This is not a story of failure. It is a story of survival without purpose. Zombie corporations persist because the system allows them to. They exist because the cost of letting them fail appears too high. Yet the cost of keeping them alive accumulates quietly, year after year. The modern economy has traded creative destruction for managed stagnation. It has chosen continuity over renewal. In doing so, it has created a corporate landscape filled with entities that endure without contributing, survive without thriving, and exist without strengthening the system that sustains them. And this is only the surface of the problem. The longer zombie corporations persist, the more deeply they reshape the structure of the economy. Their existence does not merely slow growth, it alters incentives in ways that undermine renewal itself. When survival is decoupled from performance, efficiency loses its meaning. Capital allocation ceases to reward strength and instead protects weakness. Over time, this changes how businesses behave, how investors think, and how policymakers respond to economic signals. One of the most damaging consequences is the erosion of creative destruction. In healthy market systems, failure is not a flaw, but a function. Inefficient firms exit, freeing capital and labor for more productive uses. Innovation thrives because new entrants can challenge incumbents. Zombie corporations block this process. They occupy market space, absorb resources, and suppress competitive pressure. Potential challengers face lower margins, limited access to capital, and reduced incentives to invest. The economy becomes crowded, not competitive. This crowding effect is visible across multiple sectors. Industries with high concentrations of zombie firms exhibit lower productivity growth, weaker investment, and slower wage increases. Capital that should finance innovation is instead used to refinance stagnation. The opportunity cost is enormous, but invisible. Growth that never occurs is difficult to measure, yet its absence shapes long-term outcomes. Financial markets amplify this distortion through passive investment structures. Index funds, exchange-traded products, and benchmark-driven strategies allocate capital based on size and inclusion rather than quality. As long as a zombie company remains listed and liquid, it continues to receive funding. This automatic support insulates weak firms from market discipline. The signal that capital markets should send is muted by design. Active investors face their own constraints. Exiting positions in large, widely held companies can move prices and attract scrutiny. Short selling is risky and politically unpopular. As a result, many investors tolerate underperformance rather than challenge it. The collective outcome is inertia. Banks and lenders also contribute to persistence. Recognizing losses forces balance sheet adjustments, capital requirements, and reputational damage. Extending credit avoids these consequences in the short term. This practice, often described as extend and pretend, delays resolution while increasing eventual costs. Each refinancing deepens dependency and reduces the likelihood of recovery. At the policy level, the presence of zombie corporations complicates decision-making. Tightening financial conditions risks triggering failures that policymakers fear. Easing conditions preserves stability but reinforces distortion. This creates a dilemma. Efforts to normalize policy are constrained by the fragility of heavily indebted firms. Monetary policy becomes reactive, not proactive. Structural reform is postponed to avoid short-term pain. The social implications are significant. Zombie firms preserve employment in name but degrade its quality. Jobs remain, but wages stagnate and security erodes. Training budgets are cut. Career progression stalls. Workers are kept busy but not empowered. This contributes to declining labor productivity and growing dissatisfaction, even in the absence of mass unemployment. The long-term fiscal consequences are equally troubling. Stagnant productivity limits tax revenue growth. Governments face rising demands for support, while their own debt burdens increase. Public finances become more vulnerable. The capacity to respond to future crises diminishes. What appears as stability today reduces flexibility tomorrow. Global integration magnifies these risks. Zombie firms exist across borders, linked through supply chains and financial networks. Stress in one region propagates through others. Weak firms become conduits for systemic risk. When shocks occur, the impact is not contained. It spreads through interconnected balance sheets and confidence channels. The danger is not that zombie corporations will suddenly fail en masse. The greater risk is gradual decay. An economy dominated by survival without progress loses its ability to adapt. Innovation slows. Living standards stagnate. Inequality widens as asset owners are protected, while workers bear the cost of inefficiency. This environment breeds complacency. As long as markets remain calm and employment remains stable, the underlying problem is ignored. Warning signs are dismissed as theoretical. Yet history shows that systems built on suppression rather than resolution eventually face abrupt adjustment. When conditions change, the accumulated weakness is exposed rapidly. Zombie corporations are not villains. They are symptoms. They exist because the system incentivizes their survival. Addressing the problem requires confronting uncomfortable truths about debt, capital allocation, and the role of failure in economic progress. It requires accepting short-term disruption to restore long-term vitality. Until that happens, the economy continues forward, burdened by entities that cannot move on and will not let others move forward either. Stability is maintained, but growth is sacrificed. Risk is deferred, but not eliminated. And the longer this deferral continues, the higher the price of resolution becomes. The final cost of prolonged illusion is never paid all at once. It accumulates silently, embedded in balance sheets, distorted incentives, weakened institutions, and deferred decisions. By the time it becomes visible, the price is no longer financial alone. It becomes social, political, and structural. The modern corporate economy has postponed reckoning for so long that the question is no longer whether a correction will occur, but how it will unfold and who will bear the burden. The first layer of this cost emerges when the environment that sustained the illusion begins to change. Cheap money, abundant liquidity, and tolerant credit markets are not permanent features of economic reality. They are conditions. When inflationary pressure rises, when risk premiums reassert themselves, or when confidence weakens, the mechanisms that allowed weak structures to persist begin to fail. Companies that depended on refinancing rather than repayment discover that time is no longer on their side. This transition is rarely orderly. Financial systems price risk gradually on the way down, but reprice it violently on the way up. Interest rates adjust faster than business models. Credit availability contracts faster than companies can restructure. The margin for adaptation disappears precisely when it is needed most. What looked manageable under stable assumptions becomes overwhelming under new ones. The corporate sector responds defensively. Investment is cut first. Capital expenditures are delayed or canceled. Research budgets are reduced. Expansion plans are shelved. These decisions preserve liquidity in the short term, but weaken future earnings potential. The economy slows not because demand collapses, but because supply-side capacity is quietly eroded. Employment is affected next. Firms under pressure seek flexibility. Hiring freezes spread. Temporary contracts replace permanent ones. Wage growth stalls. Layoffs follow. These adjustments are framed as efficiency measures, but their cumulative effect is a reduction in aggregate income growth. Consumption weakens. Feedback loops form. What began as a corporate balance sheet issue becomes a macroeconomic slowdown. Financial markets, which once amplified optimism, now amplify fear. Equity valuations compress as growth assumptions are revised. Credit spreads widen as default risk is reassessed. Assets that were priced for perfection are repriced for survival. Volatility increases. Liquidity evaporates in segments once assumed to be stable. Investors who relied on diversification discover that correlations rise when they matter most. Pension funds, insurance companies, and households feel the impact indirectly. Returns disappoint. Funding gaps widen. Long-term promises become harder to meet. The cost of corporate illusion is transferred from balance sheets to retirement plans, savings accounts, and public finances. What was once abstract becomes personal. Governments are drawn in inevitably. Falling corporate investments and employment reduce tax revenues. Social spending increases. Fiscal deficits widen. Public debt grows. Policymakers face difficult trade-offs. Supporting the corporate sector risks entrenching inefficiency. Allowing failures risks social disruption. Each option carries consequences. The space for optimal solutions narrows. At this stage, the narrative often shifts. The problem is no longer framed as misallocation or distortion, but as crisis. Emergency measures are justified. Support is extended. Rules are relaxed. The system is stabilized again, but at a higher level of dependency. Each intervention buys time at the cost of future flexibility. The illusion is restored, but weaker than before. The deeper cost lies in what is lost during this process. Innovation that never occurred. Productivity gains that were delayed. New firms that never emerged because capital was trapped in old ones. Skills that atrophied. Trust that eroded. These losses do not appear in financial statements, but they define long-term economic potential. The global dimension intensifies the outcome. In an interconnected world, corporate stress does not remain local. Supply chains transmit disruption, financial markets transmit sentiment, currency movements amplify imbalances. Countries with less fiscal and monetary capacity suffer disproportionately. The illusion of stability in one region can impose real costs on others. What makes this moment particularly fragile is that it follows a long period of apparent success. Expectations are high. Systems are optimized for continuation, not adjustment. Political tolerance for disruption is low. This increases the temptation to defer resolution yet again. But deferral has diminishing returns. Each cycle leaves the system more leveraged, more rigid, and more sensitive to shocks. The final cost of the illusion is therefore not collapse, but constraint. An economy that has protected inefficiency for too long loses its freedom of action. Choices become reactive. Options disappear. Growth becomes conditional on stimulus. Stability requires constant intervention. The system functions, but only within narrowing boundaries. This is the price of replacing value with valuation, cash with confidence, and resilience with liquidity. The bill arrives not as a single event, but as a sequence of limitations that shape the future quietly and persistently. And this is only the first half of the reckoning. The second half of the reckoning unfolds not as a dramatic collapse, but as a slow recalibration of expectations, power, and opportunity. When the illusion can no longer be sustained through liquidity alone, the system begins to reveal its true hierarchy. Those with real cash flow, low leverage, and operational flexibility regain influence. Those built on perpetual refinancing face narrowing paths. The economy does not break. it hardens. At this stage, capital becomes selective again. Credit is no longer granted based on size or narrative, but on demonstrable resilience. Cash flow stability replaces growth projections as the primary metric of credibility. Balance sheets are scrutinized. Refinancing is no longer automatic. It must be justified. This shift feels sudden only because it has been absent for so long. For corporations accustomed to easy money, this transition is destabilizing. Strategies optimized for cheap capital no longer function. Business models that relied on scale without profitability must adapt or contract. Mergers justified by financial synergies rather than operational logic are questioned. Asset sales increase, divestments accelerate. The corporate landscape begins to shrink before it can renew. This adjustment reshapes markets unevenly. Companies that preserve liquidity during the illusionary phase gain strategic advantage. They acquire distressed assets at discounts. They attract talent released by weaker competitors. They invest when others cannot. In contrast, firms that maximize leverage during favorable conditions lose optionality. Their decisions are dictated by creditors, not strategy. Equity markets reflect this divergence. Broad indices may stagnate even as dispersion increases. Winners and losers separate sharply. Passive exposure underperforms active selection. The idea that all assets rise together loses credibility. Risk is repriced not across markets, but within them. Households experience the consequences through a different channel. Employment becomes more polarized. Secure positions cluster around financially resilient firms. Precarious work concentrates in sectors burdened by debt and declining margins. Wage growth diverges. Inequality deepens, not because of sudden shocks, but because adjustment is asymmetric. Public discourse often misinterprets this phase. The absence of collapse is taken as proof that concerns were exaggerated. Yet growth remains subdued. Living standards improve slowly, if at all. The economy feels constrained. Opportunities narrow. The sense of momentum fades. This is not crisis. It is stagnation with volatility. Governments face a narrowing corridor of policy options. High public debt limits fiscal expansion. Financial fragility limits monetary tightening. Structural reform becomes politically costly. Each decision involves trade-offs between stability and renewal. The longer distortion persisted, the harder correction becomes. Internationally, the consequences are amplified. Capital flows toward perceived safety. Exchange rates adjust. Emerging markets with weaker balance sheets face pressure. Global imbalances widen. Coordination becomes harder as national priorities diverge. The illusion of synchronized growth dissolves. Over time, a new equilibrium emerges. It is more conservative, more cautious, and less forgiving. Leverage is treated with suspicion. Growth expectations are lowered. Returns normalize. The economy becomes less dynamic but more grounded. Whether this outcome is healthy depends on perspective. It is stable but constrained, resilient but slower. The true cost of the illusion is revealed here, not in bankruptcy statistics or market crashes, but in lost decades of potential. In innovations delayed, in productivity gains unrealized, in trust eroded between institutions and individuals. The system survives, but it does not flourish as it could have. This is the quiet ending of an era defined by borrowed confidence. The narrative of effortless growth gives way to one of limits and trade-offs. The lesson is not that debt is evil or markets are flawed. It is that reality cannot be deferred indefinitely. Liquidity can disguise weakness, but it cannot replace strength. In the end, the economy returns to fundamentals, not by choice, but by necessity. Cash matters again. Risk matters again. Failure regains meaning. The illusion fades not with a crash, but with a recalibration that reshapes expectations for a generation. And those who understand this shift before it becomes obvious are not prophets. They are simply observers who remember that confidence is not capital, and that time, when borrowed too freely, always demands repayment. If you want to understand where the next real economic stress will come from, stop watching headlines and start watching balance sheets. Look past profits. Look past valuations. Follow the cash, the debt, and the incentives that shape corporate behavior. The illusion only holds while people believe in it. Once belief fades, reality moves fast. Stay curious, stay skeptical, and remember, in the end, confidence is temporary, but fundamentals always collect their debts.